Hey everyone, my name is Sherman, a CPA here at LYFE Accounting, where we help you save on taxes and increase your wealth. I am going to help you do this today by giving you the top 5 tax loopholes for entrepreneurs. The tax loopholes I'm about to tell you are literally tax strategies that most CPAs are charging tens of thousands of dollars for. And today you are going to learn their top tax strategies for free. And all I ask for in return is that you smash the thumbs up button below and share this video with someone that you know who may benefit from it. All right, so first and foremost, it is important that you understand what I mean when I say tax loophole. A tax loophole is generally an area in the tax law that allows people to reduce their taxes. Basically, when lawmakers create the tax rules, savvy tax planners interpret those rules to help minimize their tax bill and the tax bills of their clients. And sometimes the tax strategies they create may not have been the intent of the original lawmakers, but a consequential effect of how the rules were written in the first place. But what I want you to know is that it is not necessarily illegal to take advantage of these tax loopholes. Tax avoidance is completely legal. Just see for yourself, the IRS says taxpayers have the right to reduce, avoid, or minimize their taxes by legitimate means. And with that said, let's discuss some legitimate tax loopholes. All right, tax loophole number 1, the Augusta strategy. Section 280A of the Internal Revenue Code allows you to rent your home to your business and receive a tax deduction for it. Now, here's the kicker. The money you personally receive from your business is excluded from your personal income when you file your tax return. For example, let's say you and your partners need to get away from the office to create your business plan for the upcoming year. So you decide to host a full-day retreat at your home to use the full day to strategize for your business. Well, with the Augusta strategy, you can charge your business a flat fee to rent your residence for the entire day. And then when your business pays you, it is not taxable to you at all. So here are the 5 steps you can take to start using the Augusta strategy. Number 1, select a date for a business meeting to occur at your primary residence. Secondly, choose a reasonable price for your rental based on comparable spaces in the area. Then, number 3, create a contract between your business and yourself that documents the transaction. And then number 4, have an actual business meeting on that date and document the meeting notes. Finally, number 5, create an invoice for your property and pay it from your business banking account. If you take these 5 steps, you can claim the business expense as a tax deduction and exclude the amount from your personal income. Tax loophole number 2, captive insurance. Captive insurance basically allows you to pay insurance premiums to yourself. So your business can write off the insurance premium and then access that money at a later date from your insurance company. And when you access that money from your insurance company, it will also be taxed at much lower rates. So let's break this down a little bit more. First of all, what is a captive insurance company? A captive insurance company is basically an insurance company that you create while technically it exists to insure your business of risk. Makes sense. Most businesses have some form of insurance. So instead of paying a third party for insurance, you would create your own insurance company to pay your premiums to. That way, if something comes up and you absolutely need to use your insurance, the insurance company that you created will use the premiums that you paid to cover the incident, also leaving your insurance company with the remaining profits. And if no claims arise and your premiums are untouched, then you can pull the excess reserves out of the captive insurance plan. And the cool thing about this is that when you pull money out of your excess reserves, they are taxed at lower capital gains rates instead of the higher ordinary income tax rates. So basically, there are 4 huge benefits of using captive insurance. Number one, you receive a business tax deduction for the business expense you pay to your captive insurance company. Secondly, you have legitimate business insurance that you can rely on. And then third, you save money by not paying the profit margin that third-party insurance carriers will add to their bill. And then finally, number four, you are taxed at lower capital gains tax rates when you pull money out of the captive. Now, on average, we have seen people save anywhere from 10 to 50% of the amount of the current insurance premiums they pay by switching to their own captive insurance. It's just a great way to save money on insurance and on taxes. And as we know, with all great ways to save on taxes, there are rules to follow. Section 831B of the Internal Revenue Code explains the requirements as it relates to premiums, diversification, and other federal rules that govern captive insurance plans. But rather than bogging yourself down with the semantics of these plans, I would suggest that you find a company that specializes in creating and administering captive insurance companies. Just do a quick Google search and you will find several companies that assist with this. All right, so let's move on here. My next three tax loopholes involve revenue stream bifurcation. Revenue stream bifurcation is just a fancy term from breaking your business revenue into different entities. Now, why would anyone want to do this? Well, different entities have different tax rules. And some revenue streams in your business may benefit from a particular entity type over another one. So basically, you would take all of the different revenue streams in your business and align them into specific entities that will help you minimize your tax bill. With that said, let me give you three great examples of how to use revenue stream bifurcation to lower your tax bill. All right, so tax loophole number three, S-Corp bifurcation. Creating an S-Corporation is a popular strategy because S-Corps do not have to pay the 15.3% self-employment tax. So let's say you are in a partnership or LLC with a group of partners, and they do not want to be taxed as an S-Corporation because of all the additional rules that apply for those types of entities. But let's say that you do. Well, in this scenario, you might decide to create an S-Corporation for yourself, which owns your share of the partnership instead of you personally. In this case, 100% of the income you are entitled to will come into your S-Corporation. And then you can use your S-Corporation to avoid paying self-employment taxes on the portion of the income attributable to you. And since now you are running your own S-Corporation, you may be able to find even more tax breaks. For example, you could take advantage of a solo 401k or SEP IRA, which is a retirement account that allows you to deduct up to $58,000 from your taxable income. You might also find it easier to deduct personal expenses you incur to run your business from your S-Corporation, such as your cell phone, internet expenses, home office deduction, or even business travel expenses. So as you can see here, bifurcating into an S-Corp may lower your self-employment taxes while providing you with even more tax deductions. Tax loophole number four, C-Corp bifurcation. You can also use C-Corps to save on taxes too, believe it or not. And there are a lot of different strategies you can use with a C-Corp, so be sure to subscribe to the channel if you want to learn even more ways than what I'm about to tell you. But let me just give you a simple example of how this works. All right, so as you know, the maximum tax rate for C corporations is 21% at the time of this video. This tax rate is much lower than the maximum individual tax rate of 37%. And as you know, pass-through entities like LLCs and S-Corps are taxed to the owners individually. So if your business is earning a lot of income and your effective tax rate is higher than 21%, then you may benefit from funneling some of your business income down to a C corporation, especially if you are planning to reinvest a significant amount of your income. You would pay less in taxes, which leaves you with even more money to invest in your business. And how much you intend to pay yourself from your business is also important to consider here, because you are taxed again when you pull money out of your C corporation. So keep this in mind and be sure to plan your tax plan around this. But if you never pull that money out and you reinvest it, then you will likely pay lower taxes as a result of a C corporation. All right, tax loophole number 5, QBI bifurcation. The QBI tax deduction allows businesses other than C corporations to deduct up to 20% of their business income. But the catch with this tax deduction is that it only applies to qualified business income, which the IRS defines as a business that is not a specific service, trade, or business. So let's say you offer a service, which does not qualify for the deduction, but you also sell products or other items that do qualify for the tax deduction. Well, in that example, you might decide to create a separate entity for the revenue you earn that does qualify for the QBI tax deduction. That way, you can qualify and take the QBI deduction and immediately deduct up to 20% of your business income from those revenue streams. So, for example, if you earned $100,000 in qualifying business income, you will be eligible for a $20,000 tax deduction. Not bad, right? Anyway, let me know what you're thinking about these tax loopholes in the comments below. And if you want to keep going with me here, check out my video on the top 6 ways to pay less taxes legally. Thank you for watching, and I will talk to you soon.